The era of the vanity owner is over. In 2026, the jersey on the field stays the same, but the name on the cap table has changed. Private equity has officially subbed into the game. It started as a trickle in baseball, but today, it's a flood. With the NFL's 2024 rule change, firms like Ares and Arctos have spent billions to secure minority stakes in the Dolphins and the Bills. These aren't just fans, they're asset managers treating your favorite team like a utility company. Why sports? Because in a world of fragmented media, live sports is the only appointment TV left. It is an uncorrelated asset class that has outperformed the S&P 500 for over a decade. In 2026, aggregate franchise values for the Big Four leagues have compounded at nearly 15% annually. The play isn't just the ticket, it's the district. Managers are now financing massive real estate projects surrounding stadiums. They are building hotels, luxury condos, and retail hubs that turn a 10-day-a-year stadium into a 365-day-a-year cash machine. And look at the growth of women's sports. With revenues up 240% since 2022, private equity is treating leagues like the WNBA as the ultimate early-stage growth play. Low entry cost, massive commercial appeal, and a demographic that sponsors are dying to reach. But here's the real pivot for 2026. This is no longer just for the ultra-high net worth. Through new interval funds and private wealth channels, the retailization of sports ownership has begun. You might soon own a fractional piece of the team you cheer for through your brokerage account. The goalpost has moved. Finance and fandom are now one and the same. Welcome to the institutional arena. Substack, fandom as a financial instrument headline, the KKR Arctos era, why your team is now an infrastructure play. The news that KKR acquired Arctos Partners for $1.4 billion this February is the final confirmation of a thesis we've been tracking. Sports teams are no longer trophy assets. They are essential infrastructure. In 2026, the volatility of the stock market has made the contractual certainty of sports media rights look like digital gold. When the NFL signs a 10-year, $110 billion media deal, they aren't just selling a game, they're selling a guaranteed annuity. The diversification net, we are seeing managers move beyond the Big Four. The barbell effect is in full swing. The top, massive $8B plus valuations for NFL, NBA legacy brands, Miami Dolphins, Louisiana Lakers. The bottom, high-growth emerging assets like the Northern Super League or Major League Pickleball, where PE is applying the roll-up playbook to consolidate smaller regional leagues. For the retail-focused allocator, the takeaway is clear. Sports is the new defensive growth sector. It provides the inflation hedging qualities of real estate with the growth multiples of tech.